Well, welcome to FOMC Day, where the Federal Reserve is set to resume its easing cycle after having a break of one whole year. So the market is expecting the Fed tonight to cut rates by 25 basis points. So look, that is not going to move markets at all because that is well and truly priced in. So what will move markets is basically whether or not the Fed basically aligns with the market pricing for subsequent rate cuts. And the market pricing for subsequent rate cuts is actually very dovish. So not only is the market basically expecting a 25 basis point cut today, but in the remaining two Fed meetings that we have this year, the one in October, one in December, markets priced 25 basis points for both those meetings, cuts there. And if we have a look at market pricing from now until the end of 2026, so over the course of the next year, the market has priced in now 140 basis points of Fed cuts. So basically taking the Fed funds rate to below 3%. So look, that is some very aggressive rate cuts that the market is expecting. So tonight, we will see whether or not the Fed and Powell is aligned with that market pricing. And I'd suggest that maybe it is a bit of an ask for the Fed at the moment, to match this market, dovishness in pricing, for a couple of reasons. One is that CPI is going in the wrong direction. Core CPI at the moment, year on year, last print we got was at 3.1%. So that is a good percent above, the Fed's goal of 2%. And so the real reason, and the only reason that at the moment we're getting these rate cuts is because of the weakness in the labour market. But certainly the Fed will not want to see that it starts to cut rates and that inflation actually starts continuing to go up. So I'd suggest, and I think that the Fed will probably come out and Powell talk about being data dependent. So if the data does warrant it, yes, of course, he'll deliver those rate cuts. But certainly he wants to have that optionality of, not committing, I'd suggest, to aggressive rate cuts as the market is expecting at the moment. And then also for taking back to Jackson Hole, when basically Powell did open the door for rate cuts, he did say that they would do that, treading very carefully. So look, data dependence and treading very carefully is not exactly committing to aggressive rate cuts. So I think today you need to be very cautious going into this FOMC for this very reason, that it could set up some disappointment in the short term. And probably in our lifetimes, we have never seen risk charge into an FOMC risk so big. We have equities, at record highs, S&P, NASDAQ. We also have precious metals, gold, record highs, and also silver, 14-year highs. We've got a US dollar, that's been sold off, quite aggressively in the last, week or so as well. Aussie dollar, up at levels that we haven't seen for a year plus. So yes, this market is as going in exceptionally risk bid, and I think that potentially is a bit of a risk for maybe a short-term retracement, at least from these current levels, if the Fed does disappoint and not align with the market dovishness, which is a very high bar that the market has set for the Fed. Now, the key market to watch, though, is going to be bond yields, and especially what happens to the long end of the bond yields. So we're talking about US 10-year yields and US 30-year yields. So US 10-year yields at the moment are down towards 4%, so they've come down a long way. It's a very big level, big psychological level as well. And 30 years, they've come off from 5% all the way down to around 4.6%. So they're well off their highs, and that's been a big tailwind for risk. So I would watch those bond yields very carefully after this FOMC. If they start trading back up, like they did last year when the Fed cut rates, I'd imagine that that is not going to be a risk positive. If those bond yields though did continue lower, especially say 10 years breaking 4%, obviously that's going to be risk positive. But I would imagine, as a lot has been priced in, I think it's going to be very hard to see those bond yields go lower from current levels. So again, a lot of caution is warranted for this FOMC tonight, just with market positioned so heavy long risk going into it. Anyway, good luck tonight, and we'll catch back in with you shortly.